Hello traders, welcome to Price Action Insights. My name is Chris, and today we're going to talk about the price run. The price run is a behavior that is engine driven, an engine driven behavior that we see virtually countless times throughout the day. And we're going to study it today in connection with these smaller time frames so that we really understand how the mechanics and the technology behind this move work, so that when you see what you see on your charts at home, you have a sense as to what's driving it and some of the consistencies that are manifest as a result of the technology behind uh, this type of price move. Now, it's an area that we have put a lot of study into, and I mean, I'm just going to share more or less a basic connection of how the mechanics and the price move uh, appear on your charts. The price run is the result of, or a price move that comes when one institutional engine generates a response from all others, which compounds the price movement. This is why currencies tend to overshoot, leaving a liquidity void in its trail. So let's talk about the pricing engine. First of all, it's important to understand that I'm going to say that a lot. It's important to understand. Um, but you will hear me say virtually countless times that volatility is a function of available liquidity. Price pushes to the less liquid side of the market. Uh, when and this the price movement is environment related. Of course, there are scenarios where you have a lot of supply or a lot of demand that outweighs the opposition for reasons that are rational. But there are a lot of times that the reasons are not seemingly rational, but they are a function of available liquidity. And so if we understand how the liquidity uh, the liquidity flows work, then we can get a deeper understanding of market structure and start to get a deeper understanding of price relationships. The market does not exist in a constant state of sentiment, and there's a lot I have to say about this. I can't do it now. I will do it in another session. I'm going to be discussing this point further. Um, for now, it's just words to you, and as far as what I think is important about this comment, we'll talk about it a little bit later. Um, so let's just talk about some of the very basic mechanics of the price run. Market's really busy right now, so let's actually bring over a live trade ticket. So if we look at this, actually, maybe this is a bit distracting for you. I'm going to pull this away because people tend to be a bit distracted by these things. I'll pull that back in later. Again, we're really going to refer to this in the smaller time frame because this more directly connects us to the engines. And let's just have a look at, let's say, for example, we have, and again, as I mentioned, this is a 5-minute chart on the pound dollar, and as I mentioned, these scenarios play out literally hundreds of times throughout the course of the day. So let's say, for example, we have this price consolidation and call it a low liquidity state. In this case, we're here for not quite an hour, just sitting in this range. There are a lot of other environmental factors that are contributing to the flows, but we'll just look at this in isolation right here. So that would be an example of what I've shown here. So let's just try to simplify what's happening here. So if we have a range bound environment on, call it a 5-minute chart, this can also apply to the larger time frames as well, which is fractal, but I just want you to understand the concept first on a smaller time frame. So if we are in what we call relative volume stability. So in other words, the flows coming in on either side of the market, we're seeing relatively stable volume fairly, usually the tick frequency is lower in this environment. The refresh rates and tick frequencies are lower. Um, you see less frequency in the ticks, as well as change in the depth quotes. So the market's in a relative volume of stability. You'll have a certain amount of volume that's fairly stable that's coming in on both sides of the market. It's fairly easily matched, and the consolidation just goes on. Uh, and this is not in consideration of what's going on elsewhere in the environment, which does need to be considered from a broader perspective when you're actually taking live trades. And by no means is this a trading model or telling you how and when to get in. That is a subject matter that doesn't come until you have a more concrete understanding of some of the core elements of price action. Um, Now, so what happens here is price will be in a what we call a lower liquidity state or relative volume stability, a fairly stable environment. And what will happen is whether the market comes under the influence of a data, an event, or a significant amount of volume that gets pushed into the market, keeping in mind that if you refer to our previous video, that there is a virtually endless contribution to the FX market. So when there are very substantial amount of flows that need to go into the market, they don't just push it into the market all at once, typically. So we need to be mindful of that, because when we have our depth of liquidity, what happens is that when we're in this relative volume stability state, we will actually see on, let's say, for example, on the bids, on the bid side, you might see a series of larger volume sizes against a flash weak spot on the offers. Okay, so it might be a very single short large amount of volume, or a string of large volume that hits against an expanse of weakness on the offers. And so what happens is price will start to move, of course, because you have more bids than offers. Price starts to move because the bids need to find liquidity. So it moves out of its relative volume stability state, low liquidity state, because it needs to seek liquidity. So you'll have this large order size come in, and so you'll have, all of a sudden, you may be dealing between ones and fives. All of a sudden you have 100 comes in, and so it needs to get split. So it has to find liquidity. So in order to do so, it needs to get split. So you might fill some of it in the realm of depth available. And so price pushes, it needs to find liquidity. So as price starts to move and we need to find liquidity, then the algorithms in the financial institutions make an adjustment. And it's a very finite adjustment that creates an environment where the market needs to chase price effectively. So the way the quotes come in, when prices are looking to match, the banks are they're employing a couple of things. Is technically they will slightly flash, widen, and narrow the spreads in order to protect themselves from being clipped, as well as they're employing what's referred to as last look. So not all banks do this now, and they're sort of tightening up and trying to figure out ways around it. But they'll employ last look, which means that if the algorithms have identified a large flow of orders that are coming in against an environment of demand that could potentially compromise their ability to offset or find counterparties for the trade, where because they don't want to get clipped or arbitraged on the orders, because there are a number of institutions involved, and the arbitrage puts the institution at risk. So what happens is, because they create this price chasing mechanism, not only is one bank doing it, but all of the banks are effectively doing it, and it is this simple application that they need to employ in order to protect themselves. So as the volumes come in and it creates this price chasing mechanism, then price starts to move, and as price is moving, not only does it have a large order to fill, you've actually got orders coming in behind it that may be larger or smaller. And as the market moves into an environment of lighter liquidity, because when you're in this low liquidity state, liquidity is effectively in its proximity. Liquidity is drawing away from the market, away from the market. So you have a thicker level of volume within proximity of the live quote where price is actually being traded. You have more volume in and around that area. But once price starts to move out, it moves into an area of thinning liquidity. So not only do you have this bulk of these orders coming in, and price starts to move, that's why you'll see it spike up, and then because the mechanisms get ahead of themselves and it runs up, then it ticks back a number of ticks, then it gets pushed up again. So you see price will move because that's the liquidity that's available, and you'll see it do it even more so as price runs higher. Now, this is all relative, of course, because are we talking about tick charts, 1 minute charts, 5 minute charts? What does it look like on what time frame? That's fractal, and that gets into a little bit of another area of detail in price, but we want you to understand the core mechanics of what's happening here. So we have the larger volume coming in, and it's seeking volume in a thinner market environment until it's going to get to about a liquidity pool, which is usually like a standard set of support or resistance, or a technical level where liquidity pools are typically present. So you're going to see that this price move, you'll see that if you look at the time analysis, so if you look at, let's say, for example, a 1 minute chart, you'll see that price will have start out at shorter candle bodies, longer candle bodies, longer candle bodies. So it's a representation of the thinner levels of liquidity as price starts to move. So let's just have a look at an example. So I had this pulled up earlier, and let's just walk through this. So you'll see that we're in this state of call it low liquidity, and then price starts to spike out, and you can see how, you see in this case how this gives you an indication how thin the market is. You see this body, it's blunt-ended body. This body here does not have a large wick to it. A little bit of movement here, but you see how price is getting thinner, okay, and thinner, and then very thin. So the in the same time period, in this case, we moved, call it 59 to 64, 5 pips. Here we moved from 62 all the way to around 82, 20 pips within the same period. So in one period we moved 5 pips, the other we moved 20 pips. This is because of the change of the state of liquidity. So you have two primary factors. One is the driver of price and the change in the mechanics at the bank level, and two is the state of liquidity gets thinner and thinner and thinner as you're moving back into this range. So then, as price is rising, it is also leaving a liquidity void in its trail. So liquidity, as the bids rise up, you're seeing a lack of efficiency and a lack of volume supported movement, and therefore you have a real void of bids. So once price gets in and around the highs, you've got the thinnest end of the market. Remember, the bid offer rate at the top of the market is going to be the thinnest level of liquidity. So if you're trying to execute an order up here, last look could take effect. So at some firms, your order may get rejected. We have strategies around preventing to get rejected based on the mechanics that we use through our software. We have a customized software that delivers into the market in a way that prevents us from being frozen out of the market at some level. We're not going to get slipped. That's we have a feature that prevents us from being slipped. So anyhow, so as price rises, it's just going to come right back in and fill that void until it hits a little bit of volume that starts to rebalance into the market. The other thing that I want to point out is that when just to reaffirm this, is that your depth of liquidity is going to be in a certain environment at this point in time. And so again, all we need is a good volume, a good surge of higher volume on shallow depth of liquidity, shallow in terms close proximity to current market price, higher volumes against a weak spot, and that's when this gets started. That's when this gets moving. Now, of course, it could be event driven, it could be somewhat random, or it could be central bank speak or what have you. But the point is, we see a change in the volume and the surge, and there's a response to the surge, leaves a liquidity void, and then price draws back. So we use this feature a lot in our trading. And so here we see it happen again. So we're in a low liquidity state. So as price draws into a low liquidity state, liquidity is moving away from the market in near proximity. You're seeing thinner liquidity within proximity as it slows down, and then price will run out, creates a bid void, and then feeds back to pick up a little bit of liquidity to keep the bids running. So we've had a busy day today. Even just now, price on the pound dollar here went into a low liquidity state, and then you've got resting liquidity up in this area right here, and we're in a low liquidity state, and so what would happen here is that because you have a small inside gap right here, you're typically going to see gaps in the price feed on the offer side. And those gaps in the price feed, all you need is, even just if price just stays in its natural flow, whatever volume representation we have here, all you need is a small gap in the offers, and the price will start running looking for liquidity. And where is it going to find liquidity? It's going to find it up in here. Okay, so price has come back right now, right to that point of release of this move. And here it is on the 1 minute chart. Price goes into a low liquidity state, and then it hits a weak spot, draws back up, and hits right into this pocket of liquidity. So you can see here how price went into this is a 1 minute chart now. Price went into a low liquidity state. Then we had a price release, move to the upside. You see how the candles got longer. Then it balanced out where there's liquidity present here, so it would absorb some of the move, and price stabilized. We have a move lower, and then the same is going on down here. Now, as price is moving lower, notice how the bodies are getting tighter and tighter and tighter. Even when price has to move out to pick up orders and comes back in, the wicks are also getting smaller. So here, when you're at the tightest point, liquidity again is moving away from the market. So within proximity of price, liquidity is getting thinner, and it's also getting thinner the more distant you move from price. So you see, all we needed was a very small, this euro, all we needed was a very small surge on the offers, and a weakness on the bids, and then price just moved. Very, very slight. And then it only takes like literally only one of the participating banks to either push in volume or to take a price slightly outside of this area that triggers the price chasing mechanism. Then you get it compounds, as I mentioned in one of the first slides. It starts to compound itself because it also triggers a response from the other participating institutions, and then it moves until it's going to find some liquidity to absorb it. So one way of looking at it is like this. You're in a low liquidity state. You have a large surge of volume comes in. It hits against a weaker side. That large volume needs to get distributed out and filled and offset. Price will run. So you have the bids here will start pushing against the offers. So let's just say, for the case of this example, all of the offers remain relatively the same. Just call it a balancing point of 5 or a balancing point of 5. Larger volume comes in, hits on the 5s, it's got to go up. Price has to rise to find liquidity. As price is rising, it's creating a liquidity void in its trail because it's sucking up the liquidity. It's going into a thinner state of liquidity, so it gets thinner and thinner and thinner, even though I have not shown that here. Liquidity is getting thinner, and then the bids start to create a vacuum, and then price will start to fall. So here's the other side of that move. So I've just taken one price swing and split it in half. And so what happens here is that if we assume the volume to remain the same on the offers, what happens is that in the bid run, there's a bid void in its trail, and then price just bleeds back down the bid void to the last area of volume. So this is not new selling coming in pushing price lower. This is a price move lower as a result of the void in the bids that was generated from this price run, and price just bleeds back, and it bleeds back fairly methodically. Okay, and it comes back and it hits the liquidity base and stalls. So in summary, large volume hits on a stable base of offers. Price needs to get filled, needs to run up the liquidity ladder. As price rises, the bids get thinner, gets to its thinnest point, and then price draws back down to the liquidity base. So this is to some level validation of the example, and we have done many hours of study on this, and this is just a snapshot of what is represented here. Each candle is 5 ticks, so 5 new price changes. Okay, so at 19 hours 37, price was in this low liquidity state, and we saw a surge hit the market. And so the volume surge hit against a weak spot. It took 5 ticks to go from 25 up to 50, and you see this gap right here. Price is having to, because we're moving into a thinner state of liquidity, price is having to jump to find new liquidity. And so it will jump to find new liquidity until the bids get completely exhausted, or it hits into a liquidity pool that absorb the bids, which will create even a bigger gap for a more substantial fall. So here price drops and all the way back to liquidity base. The total time for price to spike up and drop was 95 seconds. So if I pull up a T5 chart, you can see we have a stable base of liquidity. We get hit with a surge, price pushes out, the offers get exhausted, price comes back into where there's a presence of liquidity. then we go into low liquidity state, and it happens here and here and back. Okay? Here and back, here and back. Just it continues all day long. So here, look at how low of a liquidity state it was. But given that we've only seen a small price surge out of this very low liquidity state, price liquidity is actually starting to die off a little bit. So you've got a price move from here, a couple stalls along the way, down to 22. And we'll probably come back right now and hit 26 and respond at 26. So just scrolling through our 1 minute chart, low liquidity state, price surge. Low liquidity state, price surge. Low liquidity state, price surge. Low liquidity state here, price lower, then higher. We would have been very low at this point with some spreads widening. Low liquidity state, surge lower, comes back and fills. Low liquidity state, price surge. Price comes right back to the release of this move, lower to pick up liquidity. Stable liquidity state, price move. Stable liquidity state, price move. Slowing stable liquidity state, price move. Price draws back. These moves occur virtually all day long. Price stability, short move to new price, price stability, short move to new price, price stability, short move to new price, happens all day long. Now, when you watch these videos, typically when, because I know we have a wide range of experience that come in here and watch these videos, but typically those who are newer or less experienced are typically watching a lesson like this on some basic elements of market structure, and they're thinking, well, how do I know when to get in? How do I use this? When do I get in? How do I use this with my models? When do I get in and when do I get out? You need to completely remove yourself from that way of thinking and just understand the concepts as though it's a project, and understand market structure, volatility, price relationships, order flow. Understand the core of this, then you start building out your trading model from there. You can't just copy what somebody else does, because there's way too many holes. It's like learning from the top down. You have to learn from the bottom up. And so just completely remove yourself from that way of thinking, and that way you'll be able to internalize on a deeper level an understanding of price behavior.